Hi, I'm Russ Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Chris Verrone. Chris is a partner at Strategas and heads up the firm's technical and macro research effort. Chris, how are you this morning?
Ross, it's great to be here. Thanks for having me again.
Yeah, great to talk to you. I want to start by looking back a bit. We had somewhat of a historic first 9 months to the year. I wondered if you could put that in context and then give us any insight onto what that might mean for the final 3 months of 2024.
Yeah, it certainly was. I mean, S&P up about 21% through September. That would rank ninth historically, going all the way back to about 1950. And the question we always get is, well, does that mean you're due for some type of a setback or a correction into the final months of the year? And actually, when you look at that data historically, what you learn is October tends to be volatile regardless of what the preceding 9 months were. But once you kind of get past that, the final really 2 months of the year into the start of the new year actually tend to really run in line with the historical averages. And we know we're in one of the better parts of the calendar here regardless. So we would expect, just given how strong this market's been internally, that strength can persist as we move into, say, January or February of next year.
Yeah, and one of the kind of keys or hallmarks of this bull market over the past couple of years has been its narrowness, right? So all-time high after all-time high, but with the caveat that it was only a handful of stocks really driving the move for a lot of that. I think that's changing, but I wondered if you could give an update as to the breadth story, both within the US, what sectors are working, and then maybe internationally as well, if there's anything that stands out.
Yeah, we never really bought too big into that story that was only, five, six, seven stocks driving the whole move. I mean, for basically the entire year, you've had between 70 and 80% of the S&P 500 above its 200-day moving average. So certainly, I think broader than it's described. As we kind of start the fourth quarter here, we have just under 80% of issues above the 200-day. That's about as, really as good as we've seen this entire cycle. So I think there's a difference between talking about participation and talking about leadership. I think certainly over the last 18 months, the leadership has been driven by tech or some of the mega cap growth stocks. But the number of stocks participating in the broader move, I do think, is better than people have given it credit for. And when you look geographically as well, I would really emphasize. I think maybe the biggest story of the year is what's happened in the last, call it 2 weeks out of China. And I think the significance is not necessarily what it means for Chinese stocks, but what does it mean for what comes after U.S. soft landing? If the Chinese are going to re-stimulate here and commodities are going to rally, rates are going to go up, does it actually mean that the next stop after soft landing domestically is maybe some global reacceleration? And I bring it up because everywhere we go, the question is, Chris, do you think we'll get a soft landing? I think that's the wrong question. We've had a soft landing. For the last 18 months, the market has traded soft landing. I think the more appropriate question is, what comes after soft landing? I think the consensus has been very much of the view that after soft landing, you get some slowdown in growth. I'm not so sure of that. And what we've seen not only with the Chinese here over the last 2 weeks, but 50 basis points from Powell, I think opens the green light for other central banks to be more aggressive as well. Is the next destination after soft landing some reacceleration? You have to at least consider it here.
Well, and as we look to what comes next after soft landing, we're looking out to 2025. There's obviously a lot on the calendar that could drive markets. I wonder if there's one indicator or one item that you think is especially important for how the story of 2025 plays out, or something that investors should be watching to get a handle around 2025.
Well, the old rule, don't ask a sell-side analyst for one observation because they can never stick to one. And I'm going to break that rule. I'm going to give you two things here. Number one, I think if the next destination or the next stop is some reacceleration in growth, you can't have bond yields undercut or go below where they were pre-FOMC 2 weeks ago. When the Fed went 50 2 weeks ago, 2-year yields were at 350, 10-year yields were at 360, and 30-year yields were at 390. We've bounced off those levels. I think if the market's really going to kind of express the view that they've been placated by 50 basis points from the Fed, you don't want to undercut those lows in yield. So that's certainly something we'll be watching over the next 4, 6, 8 weeks into the final months of the year with an eye on 2025. I think the second most important thing, and you've certainly have seen this in our work, is what that discretionary versus consumer staples pair is telling us about the health of the consumer into next year. And we always look at that equally weighted. I don't really care how Walmart's doing versus, say, Amazon. I want to know, what is the average consumer cyclical doing versus the average consumer defensive. And that's quietly back at the highs here. So if the market saw something just devastating out there with respect to consumer, I think you're beginning to see that pair weaken. And that just hasn't been the case yet. Like anything in this business, things can change, but we'll certainly try to stay on top of it as they do. I think right now the setup into next year is probably still okay.
Well, and as things change, we'll look forward to getting a chance to talk to you again. Chris, thank you so much for the insight today, and we'll look forward to that. So have a good one.
Have a great weekend.